We detected an unusual trade worth $2 million on Arista Networks, ticker symbol ANET. But here's what makes it even more interesting. This unusual trade happened in the final 10 minutes before the market closed on June 11th. And so in this video, we will analyze this unusual option activity to find out if this wealthy investor is bullish and buying, expecting the stock to rise, or bearish and selling, expecting the stock to drop lower. Because as we all know, the rich have more access to exclusive research and information, sometimes even leaked insider information, to make better, smarter financial decisions. This is how smart money always seems to be one step ahead, well before the rest of the market catches on. And so without further ado, let's dive into our analysis so that our subscribers and members can profit from this deep knowledge too. As we can see here on the options time and sales tape, on June 11th at 3:50 p.m., just 10 minutes before the market closed, these November 21st options at the 125 strike calls were being traded multiple times. And we can see the price was about $3.70 each. Keep in mind, this is options prices. And so we either move the decimal 2 places to the right or multiply by 100 since each option represents 100 shares of stock. And so each of these contracts cost $370. And so how many contracts were there? Well, let's dive deeper into the data. We can see here from the historical data on June 10th, before the unusual option activity occurred on June 11th, that the open contracts previously for these November 21st options, there were only 627 open contracts. And now that the data has updated, we can now see that for these November 21st options at the 125 strike calls, there are now 6,098 open contracts, which means that the number of new opening contracts is 6,098 subtracted by the 627 open contracts previously, and we get a total of 5,471 new opening contracts. And since they paid about $370 each, we multiply that out and we get a total trade cost of approximately $2 million for this trade. But keep in mind, just because a trade is large does not necessarily mean it has a high probability of success. In fact, this one carries more risk than the smaller, more selective trades we share on our website. And so if you want to get access to the lower risk trades with a higher probability of profit, then go to our website. We'll put a link up here. Keep in mind that our members also get earlier access to trades like this before anyone else, before we share it with the public. So if you're tired of trailing the crowd and want more time to act on these opportunities, just head over to our website, where you can see in real time when and which stocks wealthy investors are trading on Wall Street, so that you can have the same opportunities as the rich. Because if the rich get richer, why shouldn't you? With that said, even though this is higher risk, we still traded this, but we use position sizing to manage our risk. As you can see here, our position is here at the 125 strike calls. The green color indicates a buy position because based on our deep analysis of other data sets and variables, this wealthy investor bought these call options for $370 each, as we saw earlier on the options time and sales tape. And so when we analyze this trade, we can see here on the risk profile where the profit loss shows up here, and the x-axis represents the share price of the stock, which is currently trading over here. And the y-axis represents the profit loss. Note the zero break-even line here. And so when the purple line, which represents the current date, and the blue line, which represents the option's expiration date, are trading below the zero break-even line, as the share price goes down, this trade becomes more negative loss. And if it trades above the zero break-even line as the share price goes up, this trade becomes more positive, more profitable, because this is a long bullish trade, and we can confirm it on the Greeks. We have a positive delta trade. If it was a short bearish position, it would be a negative delta instead. But keep in mind the risk with this trade. We have a negative theta, which means this trade loses value as time goes on due to time decay. And that is why you can see here the purple line drops down lower to the blue line as we approach the option's expiration date. And that is why the break even on this trade moves higher as time goes on. And so you can see here, even though the call options we bought have a strike price of $125, the stock needs to trade above $128 per share for this trade to be profitable at expiration. Because of this added risk, along with other factors, we only took a small position in this trade. We don't invest a lot of capital into these higher risk trades. Instead, we focus most of our capital on the lower risk, higher probability of profit trades, the kind of trades we share on our website. We'll put a link to our website up here where you can also learn more strategies to increase your profits. Let us know in the comments, do you think Arista Networks will move higher or do you think it will drop lower? As always, please like, subscribe, and until next time, let's keep tracking the trades of the rich so everyday investors can profit too. Take care and have a wonderful day.